Today's meeting is going to be very informal. The topic is around what investors look for, specifically with startups. So we're going to kind of look at this from both sides of the table today. I'll give you my quick background for those of you that don't know me. I'm Craig. I am the CEO at Growth University. I'm also a small check writing angel investor, also a 6-time founder. I've been through the fundraising process a number of times, actually. And it's been wildly different each time been through. So I'll walk you through some of the best practices that I've found. And I'll also talk through some of the growth metrics that investors are looking for. We'll talk a little bit about growth modeling and how to put things together in a way that makes you sound intelligent when you go to raise money, and really avoid the weird scenario where you get asked a question that you can't answer. And if people are interested, I'm happy to walk you through our current seed round pitch deck as well. And I posted this in Slack as well. We are in the launch accelerator, and we're doing a small round right now. And Jen, my co-founder, is actually pitching in about an hour and a half. So if folks want to see how the launch accelerator companies pitch, hit me up. I'll share the link. I shared it in our Slack. But there's going to be 7 companies pitching at 3:00 Eastern. So Jody, Peter, Juan, Joe, Sean, I think, that'll be a really interesting segue from this conversation, because we'll kind of go in the weeds here, but then you can see, how do people position these things in 3 minutes? Where I want to start is, and also, by the way, just interrupt me at any point. I don't have a slide deck. I will share my screen at different points. The agenda is light and loose. So let's have some fun with this. I know at least one other person in the room is an investor, but if you're an investor, feel free to speak up and give your point of view. And if you have raised money as a founder, also feel free to speak up and raise your point of view. My goal for this session is to add some more transparency to this fairly opaque process that is fundraising. So let's get right into it. Show of hands, who's raising money right now? Put yes in chat. Jody, yes. Who else is raising money? Drop it into chat. Patrick, are you raising money? Yes, Juan is. Okay. Yeah. Peter, I'm not sure. Okay, so most of us are here raising money. And who here has raised money before? A little bit. Okay, I have. Anybody else? Juan, I think you raised, I believe so. Peter, not presently, but you have raised. Okay. I think the days of raising a round off of zero traction are over. It has become incredibly hard to raise money, even in a not wild market like what we have right now, without traction. And so I would say, for those of you that are kind of heads down in product building mode, my first piece of guidance would be, and I'll define traction in a second. My first piece of guidance would be launch. Like, get the thing that you're working on live and start to drive some of the leading indicators into the model that may become traction metrics down the road. Okay. So when we think about traction, often our heads go straight into revenue metrics. I'm at X% MRR. I'm at Y% ARR. In the case of Growth U, we've got monthly recurring revenue. We've got annual recurring revenue. We sell some stuff monthly. We sell some stuff in advance on an annual plan. We sell one-off services. We sell one-off courses. We sometimes sell blocks of hours. We run an in-house agency. I mean, there's so many different aspects to our business. So how do we quantify it? Well, investors typically care on the metric side about monthly recurring revenue or transactional revenue if you happen to be a marketplace or a consumer company. But those are lagging indicators. So by the time you go to raise a larger round, call it like a seed round and beyond, you're going to be well on your way to monetizing your product. It's very, very rare to raise capital in 2022 without having metrics that look like 5,000 to 10,000 monthly active users, or $5,000 to $10,000 in monthly recurring revenue, or $5,000 to $10,000 in transactional revenue coming through. So if you're a marketplace, that might be 25 to 50,000 in gross marketplace value, so GMV. Maybe you take 3% of that, so that's $1,500 to $3,000 in actual revenue per month. So while that might be daunting, there's other things that in earlier rounds investors are looking for, and specifically they're looking for pockets of micro traction. And what micro traction is an area of growth that you've seen with your business that you believe will lead to those core metrics that's most important for your business model. And again, I'll go through these again, and then I'll show a spreadsheet. If your subscription model, it's going to be monthly recurring revenue, it's going to be number of new subscribers, and it's going to be total subscribers that are in your ecosystem. And then you'll have a churn metric. If you're a marketplace model, you're going to have supply side and demand side growth, and it's probably going to be some combination of subscription and transactional revenue. And if you're a consumer company, it's probably going to be user growth and then some ability to monetize, whether it's through advertising model or direct to consumer, something like that. What we're seeing across the board so we have got about close to 100 companies that we've got data on now through Growth University for the pre-seed rounds and the angel rounds that are either friends and family or small angel rounds. We're seeing founders successfully raise money with under 5K in revenue, but they generally have these fairly strong micro traction metrics. And let me define what that looks like. So you've figured out one or more channels to acquire customers that show some usage in your product. Whether or not they're paying, with some conviction, you've gone into the market, you've put your product in front of people, they're signing up, and they're actually using it. If you can tell a story that shows pre-revenue growth, you're on your way to being in a spot where you can tell the story to raise money. Now, different industries, different verticals are going to have different core metrics there. And I don't have all the numbers off the top of my head, but there's some benchmarking that you can find. And what you want to look for is that you've got an indication of future revenue growth or subscription growth from the micro traction that you're running. So a great example, where I would, for example, look, if I were going to pursue investing in a startup is, hey, founder, tell me about how you're acquiring users. Notice I'm not really talking at this level about the product, because I'm assuming that the product is in a somewhat sellable state, and that the founder has put themselves out there and is actually either monetizing or trying to grow user growth into the product. If you're not at that point yet, you probably shouldn't be thinking about fundraising, because you've got a product iteration or a market iteration to go through. And if the founder comes back to me and says, hey, we ran these experiments in Facebook, we spent this amount of time on organic search, and I built a cold outreach campaign that got me X, Y, and Z results, and that led to actual product usage, we've got a conversation. Now, it may not be perfect, it may not be pretty, you may not give all the backstory, but what the investor wants to hear is that you have quantified something that's important as a leading metric for your business, and you've got the product, you're in a spot where you're ready to go, and you're going through the legwork to actually try to grow the business, right? This is why we stress with a lot of our teaching about launching early. And there was a famous investor, I forget who it was, who said that they invest in dots, not lines. So like little snippets of growth here and there, little bits of micro traction in different channels. It doesn't have to be a completely comprehensive growth plan and strategy that you're going after, but you have to be talking to customers. And if you can come in with conviction and say, hey, I've got this customer base, here's what they're saying about it, we're future monetizing, you've come to step one. So I want to pause there for questions, because what I'm going to move into next is going to dive a little bit deeper. And we're going to look at some of our, a way that I think about a growth model and pitching the vision of the company. It was Mark Suster. Thank you, Peter. It was Mark Suster, who I actually got to pitch in person with one of my previous startups, Red Tricycle. We went to Santa Monica, met him at it was like a beach bar. It was literally on the beach. Like I remember sand being outside. And we did not close capital from Mark and his crew, but the company ended up doing well in the long run anyways. Okay, any questions so far? Okay, cool. We'll keep rolling. So let me walk you through what we're doing from a modeling perspective. And this gets a little bit deeper. And so just bear with me as I pull this up here. So when I started Growth University, I had started it with Jason Calacanis, who had found a need for his startups and the startups that Launch was investing in to have some standardization around how they think about growth and growth modeling and how to even think about metrics. And this is a workshop that we still do with all the accelerator founders to this day. And they're actually using a set of spreadsheets that's very much like this. When you're building your startup, you have to think about all the stuff that I already told you about, but you also have to pitch the forward-looking vision. And what I'm going to walk you through is a forward-looking vision for a subscription business model. And it goes something like this. I'm going to pretend I'm pitching you. And I'm going to pretend this is our second meeting. Hey, everybody. Thank you so much for taking the second meeting. You know, last time when we met, you were starting to dig into our growth model and to our metrics. And let me walk you through how we think about growing Growth University. Growth University is a subscription. By the way, this is fake data. Growth University is a subscription product. We charge $25 a month for access. We believe, based on what we've seen so far, that we're going to grow at roughly 20% month over month. So that's our top level growth metric. And based on our early data, we're seeing about 5% monthly churn. We're starting out, we've got 20 subscribers already that are our early adopters. And our early experiments on paid acquisition, we've tried tests in Google and Facebook. It shows a $50 customer acquisition cost, give or take. So we have to spend about $50 to get each and every customer. Now, let me walk you through how this works. In January of this year, we had 20 subscribers. We acquired 20 new subscribers. We ended the month with 50. We had 5% churn. Our total monthly recurring revenue was $1,250. By the end of year one, where we expect to be is at $17,000 in monthly recurring revenue. That's going to have us showing 687 active subscribers. And in that month of December 2022, we'll have to acquire roughly 150 customers. Now, that's going to cost us about $7,400 based on the model that we've already worked out with a $50 customer acquisition cost. We're going to be spending about $5,000 a month on headcount. We're a lean and mean team. There's 2 of us working on it full time, which means we're going to have about a $4,700 P&L will actually be at profitability. Now, this is wildly underestimated, right? Like if we're going to put our fully baked costs of our startup in, we're probably losing money for quite a while. That's why we raise money, right? We raise money so we can lose money in the short term and then make more money in the long term. Okay. So, but notice what I did. I set up our subscription cost. I set up what I think our growth rate's going to be. I set up what our churn is based on what we know so far. I set up how much we have in terms of actual subscribers and new subscribers. And I've already got data on our customer acquisition cost, right? So if you're raising capital and your metrics they're not amazing, but they're okay, right? But you can put together a map that looks something like this, that pitches the vision of where you go. I will tell you that you're ahead of 95% of the founders out there. Quite literally, you'll be ahead of 95% of the founders out there. If you come in with a model and you can pitch the model with conviction, you're going to be in a much, much better spot. Let me show you our model. and we'll cut this out in the video because I don't, yeah, Joe, this is very much telling a story using numbers. You are absolutely spot on. The challenge that a founder has, right, is balancing telling the story using numbers and forward-looking metrics versus mapping to the reality of what's happened, reconciling what's happened with what's coming up, and pitching that story and that vision. But notice I haven't even cracked open a pitch deck yet, right? This is just like, this is what happens in a conversation with an investor. When you get it to a point where you're going to do due diligence, and Jody, I'll show you in the deck. I'll show you what we put in the deck to get the meeting. I'll walk you through. I'll actually walk you through our pitch. It takes 3 minutes in a second, but I want to go in so that you understand what's behind this engine, right? It's this. So for our seed round, and I'm not going to share this publicly, this is a friendly group. I and any of our investors have access to this. We are looking at a $1 million cash infusion, and we're going to get to roughly $1 million in ARR by the end of 2022. And we'll do another $400,000 in non-recurring revenue. And with our aggressive hiring strategy, we'll be burning anywhere from $45,000 a month to $70,000 a month. But remember, we've raised $1 million that's in the bank, which is growth capital for our business. So this is what I call our aggressive model. Okay. And this is the vision that I pitch. And I can say with conviction, we're actually on track for $1 million in ARR. In fact, we are. Like, we just sent out our investor update 2 nights ago, and we're at 28,000 in MRR, and our growth is 25% a month. So we'll get to that $1 million in ARR unless we really screw something up, or the market changes, or there's another pandemic, or. Okay. So let's break this down a little bit further. I'm going to have 12 full-time employees. Our cash balance is X, and I've changed some of these numbers, by the way. So, this is, some of this is obfuscated, but roughly 123,000 in revenue in December 2022. This is our MRR. This is our ARR. This is our non-recurring revenue. Our month-over-month growth rate is going to be 20%, 17.5% month-over-month. Notice what I did here. I put 8%, 8%, and 8% for July through September. Why? Seasonality over the summer, it really impacts our business. So because we have a year of data now, I readjusted our model for 2022 to set the expectation that, look, it's going to be a little bit slower over the summer. Let's just own it. Okay. Guess what else we're doing though? We're going to pull back our ad spend in July, August, September. So when I open up a little bit more here in terms of rows, you could see salaries, you could see ad spend, you could see course creation, you could see legal, you could see total expenses, scratch P&L, EOM bank, full-time employees, who we're getting, when we're getting the money in the bank, new MRR, ARPU. Okay. So this is how we look at it. It's fairly complex stuff. I would start with something much more simplistic. Okay. So I want to show you one more thing, and then I'm actually going to pitch you, but we've got some questions coming in here. Okay. So Eunice, you'd asked, would it help to have a breakdown of the CAC for each marketing channel? Yeah. I mean, I think one of the questions you're going to have is how are you going to get 35 new subscribers in the 4th month here in our model? So that would be in April. And I love asking that question when I'm looking at a deal. As a marketer, I'm not trying to stump the founder. I actually, part of why you build the model is so that you understand what you need to do in a month to hit your growth metrics, right? Remember, we're growing 20% on revenue every month, which loosely equates to needing to get 35 new subscribers in that month to get to the 126. We pull churn. This is all auto calculated, by the way. You can hack this model as you see fit or build your own, but this is what we do. So we pull churn out of it. Well, how the hell are you going to get 35 customers? Now, this for me, I would say, well, there's 4 ways we get customers right now. Cold outreach, paid ads, organic content strategy, and partnership marketing. We're scheduled to get 35 customers in April. We believe it's going to be about a 25, 25, 25, 25% split. Our ad spend is going to be this. Our CAC is going to be around $50. You don't really need to get into CAC by channel. I've actually never been asked that by one of our existing investors, believe it or not. It's something that I look at, Eunice. Like, I definitely look at CAC by channel because I think CAC by channel gives you a sense of reality. What's your worldview look like when you're out there spending money to get customers? Okay, so I'm going to dive in and show you one more thing. So this is great. This is all just like modeling, but guess what? The model is just the model. The model changes every month. The model might change every day. I mean, Aoife Dunn here sees our growth model, and every Monday morning, like clockwork, I walk the team through the metrics. We talk about what worked that week, what didn't work that week. And we say, well, what is our theme and what is the goal for this week? And then every Friday, we also get together and we kind of do a workshop as a team to try to get ahead of what's happening next week. Okay. And a lot gets done on those. We're a remote first company. We've got people in different time zones. We get together as a team on Mondays and Fridays. That's when everybody gets together at the same time. And we get a lot of stuff done. And a lot of it is based on the metrics. Okay. Well, one piece of revenue is lagging. Okay. Well, you can't wave a magical wand and just close more deals. If a revenue metric is lagging, you have to figure out what the leading metric into that lagging metric is. And so in our case, before we ever sell a training package to somebody, right, on the $150 a month plan, occasionally somebody will come to the website and just sign up for our subscription. But most of the time what happens is they come to a webinar and then they download something and then they see me talk somewhere and then they hear from Aoife and then they hear from marketing automation. And then 2 months later, they realize, you know what, I really need to learn how to do Google advertising the right way. I remember Growth University had a course on that. They click and they either buy the course or they buy the subscription. It's a long game. So our leading indicator is a lead. In our case, a lead is an email address. And a lead is broken into general lead, marketing qualified lead, sales qualified lead. And we have sophistication behind the scenes with HubSpot that uses lead scoring to tell us, if I log into HubSpot right now, I can tell you with some level of accuracy, which of our leads are going to convert to a deal in the next 30 days. We can actually forecast that and build a pipeline now, which is why I know roughly what our growth rate is going to be every month at this point. Again, we have a year of data. Early on, we had no clue. Every day that goes by, we learn more about our acquisition costs, our channels that work, how we get customers, what they're willing to pay, how long they stick around. Okay. Let me show you one more thing. So again, these are forward-looking models. What I want to stress here is the importance of a backward-looking model, and then I'll tie it into why this is important for fundraising. The companies that own their metrics raise money faster. The startups that can tell you what their forward-looking model looks like and can tell you what the heck is happening in their business when they look back at it, they are the ones that get the meeting, get the second meeting, and close capital, right? Because they are trusted by the investor. You're still going to have 100 meetings to get the one investor, right? But you might not need 200 meetings to get the one investor because you got your stuff together. Joe asked, do you look at lead scores by channel? Yes, we do. Although our MQL, our marketing qualified lead attribution, is less concerned with channel than it is about what are they doing? How often are they coming back to the site? Did they visit our pricing page? Did they download a curriculum? Did I have a conversation with them? And I think, what is it, Aoife, 30 points gets them to be a marketing qualified lead?
Yeah, 30 points, correct. Yeah. Yeah. And then we just, I suppose, so we have an automatic process then that gets sent to myself, I suppose. And what we do then is we have a system for tracking them. And then also when they convert to a sales qualified lead too. So I suppose it's a process between myself and Craig. So trying to manage that, that side of the business too. So there's no one kind of, I suppose, slipping through the cracks as well. Yeah.
Yeah. And that was built after a bunch of failure on sales. When I was running sales on my own, I like to joke with the team that I think I bring a lot of founder anxiety into sales calls. And when we introduced Aoife as the first meeting, I mean, Aoife here is our head of training. So she's at the leading edge of what startups need from a training perspective, which also puts her in a really interesting spot to understand, well, what are some of the more hands-on services they might need? What are some courses that they might need that we don't yet have? What tools do they need? What should we be building behind the scenes? And that process now, when I come in as a closer, it's just worked a lot better because we've distributed that workload, and I don't bring my founder anxiety into sales meetings anymore. Anybody else with me on this? Anybody else? Jody, yep. Tag team sales if you can. Tag team sales if you can. Tag team fundraising if you can. I have Jen, I've raised money a bunch. I have Jen, my co-founder, she's become our ringer with fundraising. She presents really well. She knows our metrics, and she's awesome. So I have a partner in crime on fundraising now, which was never something that I would have expected when we started working together. It's just, so if you can get that help, get it. Okay, what we're looking at here though is a growth dashboard. So again, we looked at our forward-looking growth. This is, I think, a lot more important. So what we're looking at here, this is fake data, but the week of January 9th, what the hell happened with our business? What happened? What are we trying to track? Yes, we've got Google Analytics and we've got HubSpot and we've got all these fancy analytics tools. Okay. They can tell us everything, but they kind of tell us nothing if we don't know where to look. So there's three things that I care about in our business. I care about what's happening at the top of funnel. How much lead velocity are we getting? Jody, yes, we will. Oh, Jody had to pop off. She's got a crowdfunding. That's awesome. Yeah, Aoife, we can maybe send Jody the recording. Yes.
Of course, yeah.
So what's happening at the top of funnel? The top of funnel is something you can influence by applying more money or more time to the equation. So I like to look at, and every startup's a little bit different. My top of funnel metric, our top of funnel metric for Growth University is website visitors. You might have something else that you use. It might be app downloads. It might be app installs. It might be something else. Then we have what we call an EPAG metric. And for those of you that have taken the Mastering Growth program, EPAG is endpoint acquisition goal, and it's the handoff between your top of funnel and your middle of funnel. So for us, for all of our automated sales stuff, so not counting anything that we might sell as a growth agency, our core metric for middle of funnel is a free trial sign up. So if we can get somebody in a free trial, we'll close 70% of them into a paying subscriber. But it's really hard to get somebody onto the trial. In fact, with Growth University, actually, we have a $1 trial. Free trial is a lot easier. $1 trial is what we use. We close 70% of those into the deal. We did experiment with free trial. The problem we had with free trial was really high churn. So you'll figure out what your middle of funnel is. Notice what I'm looking at here now. What I want to see is week over week, what's happening with my conversion metric. So we've got these leading metrics and we've got these conversion points between these metrics. What's happening with my visit to trial ratio? What percentage of my visitors, of my unique visitors on a weekly basis are turning into a trial? And ideally that's getting better over time. Okay. So this is looking at, so the columns are weeks. These are backwards looking metrics. Okay. The last thing is subscribers. So how many subscribers did we get in that week? And then what is my trial to subscribe ratio? So what percentage of people that got into my trial, ended up subscribing. Now, this is not perfect data. This is not looking at cohort. This is looking more at blended. So it's going to give you more of a directional sense as opposed to a statistically significant sense of what's going to happen to your metrics. But it's a good enough proxy, I found, and I've seen this with many, many, many businesses. It's a good enough proxy to understand on a week-to-week basis. There might be some lag time between trial and subscribe, between trial and revenue, but generally you also want to see that metric getting better over time. And then I look at things like revenue, week over week growth. So these conversion metrics here, row 13, row 9, and then row 20 are as important to me as our actual planning that goes into the growth modeling, because what this tells me is what's actually happening week over week. Now what we do, so everything to the left of this little line is historical. Then what we do is we run a running forward-looking mini model here. And what I do here is I drop in what I think is going to happen next week and the week after based on what's been happening before. Exactly, Joe. It's like an income statement for subscriptions instead of, or users or whatever, instead of money. Because remember that money is lagging. It's always lagging. Founders that come in and pressure the team to drive more sales often don't realize that the team can't do a lot about revenue. What the team can control is generally the stuff before revenue. Maybe a sales rep can control revenue, but by the time you get to revenue, it's such a lagging indicator that you have to have a sense of what's happening before that. Okay, so what I do here is I drop in what I think is going to happen. And so in this case, I go from 213 website visitors to 500 to 1,000. Well, that means that I'm just likely spending more money in acquisition, or I found a new partner to join and to promote us, or we're doing something else that gets us that visibility. And then what I do is I drop in what I think my conversion rate is going to be. Okay, so this 3.6% is based on, it's effectively an average of the last 4 or 5 weeks. And then I calculate this number 18. So this number 18 is 500 visitors times the 3.6 conversion. That'll give me 18 trials. Now, if we look at column I, if I'm looking at 2 weeks from now and I have a conversation with my team says, hey, we're going to push in a little bit more budget in 2 weeks, and we're going to do some more stuff on Facebook and some more stuff on Instagram. We're going to run an experiment on TikTok. We think we're going to drive twice as much volume that week. I'm going to drop the conversion rate because I don't know how that traffic is going to perform, right? So when I build my mini model here to adjust for, again, adjust for forward-looking purposes, I bring that down to 2.5%, which is considerably lower. But I think because we're going to have to learn about how marketing works in these channels when we increase our spend. In this case, I get 3 subscribers. In the week of 220, I get 5. Now what's going to happen? I'm going to drop in what I think my conversion rate is going to be. Maybe we continue to iterate and make our funnel a little bit tighter, and we make that conversion process better. We send better emails. We do more follow-ups. We add more value. And so I think we can get to 20% trial to subscribe conversion rate. And then I can actually formulate what I think my actual revenue is going to be and what my week over week growth is going to be. And then any guesses to what I do with this? Once we look at the last couple of weeks, I go back to my model and I readjust my growth model based on what I'm learning from my dashboard. And that process basically never ends. So for us, I started quite literally with this set of spreadsheets, and now we've got a couple of different things that we've added. I mean, ours looks a lot more complex now because we've raised capital and we've got a bigger team and there's more stuff going on that we need to track, but this is it. Okay. So where does this come into play for pitching? This is our actual pitch. And I'm not going to go through the whole thing unless people want me to. I'm happy to pitch it as if I'm pitching an investor, but where I use this is here. I tell the story here. I show our metrics here. I talk about our pricing here. I show our metrics here. Looks like this needs to be updated. Let me, always a little scared to click that update button. I show my metrics here. That needs to change. I show my competitors here. I show my go-to-market here, including my channels. Notice what you see here, my customer acquisition costs, and then my lifetime value. Now, lifetime value isn't something that we looked at here. I'm happy to answer questions about how we would look at that after if you got it. And then how do we become a giant company? All of these charts and graphs are just derivatives of my original models. All right. So what I would do is I would include a charts and graphs slide here. I think I've got one here to show you. Yep. Something like that. Pretty graphs, pretty charts based on the data. Take those, copy them back to here. So when your investor says, well, how do you become $1 billion company? And you have to answer with a straight face, with conviction. And guess what? What you say has to make sense mathematically and logically. Now I can say we get to 100 million run rate when we've got $1,000 a month paying customer, and we've got 8,000 of them. You run the math backwards, it's like around 8 million in monthly recurring revenue times 12, roughly 100 million. Okay. 8,000 is a lot. We're a long ways off from there, right? I showed you the other chart. We've got, how many subscribers do we have? 80. Okay. We're 1% there. Now, the other thing that's happening though, because we know our metrics, in the case of Growth U, our LTV is actually going up really, really quickly. So once we get somebody in the door, they're buying more and more stuff with us, which is a really healthy metric. Not all the time, but a lot of the time, the trend is up. If we look at this, our customer acquisition cost against our projected lifetime value, what you want to see is that that red line is considerably higher than the blue. Now, March is weird, right? Because in March, we only spent like $600 on advertising in March. And so our customer acquisition cost in March was really, really, really low. And at the same time, our lifetime value, our estimated lifetime value crept above $12,000, which a year ago our lifetime value was under $1,000. A year ago, our average user was paying, is that about 85? It's well below the 100 range. See Jen in here getting ready for her pitch. And by the way, these pitch decks in these worksheets become living, breathing documents. I mean, we literally use them all the time. And the month of March, our average revenue per paying user for the new people that signed up in March are spending closer to $700 a month with us. Okay. So these charts come together when you start to understand what data you need to track. And remember, early on, I mean, look, it's very, very, very flat for a very long time. Eunice, you would ask, do you include metrics of follows, link clicks, et cetera, for Instagram, Twitter, Facebook as a way to test which type of marketing is working? Yes, but that stuff doesn't really make it into what I would call the investor view. Okay. Now, Jen on our team is very focused on our cost per click, our cost per lead, our cost per, our organic content strategy, our paid acquisition strategy. So we have a part of our team that looks at all of that stuff and uses those metrics as an indicator for us as to how well that channel is working for us. Okay. But we don't, that doesn't make it into this model. Now, look, when we talked about micro traction a little earlier, like this stuff is pretty complex and I teach this stuff, right? So you're not expected to do this. What you need to be able to do, to Eunice's point, is say in channel X, here are my metrics. And this is why I think we're really onto something. Let me show you. So Eunice, if you don't have this type of deep data yet, use what you've got and build the narrative and story off of the data that you do have, and tell the best story that you can, right? Tell the best. That might be that you've got a wait list with a bunch of people on it. Okay. Now, if you've got a wait list with a bunch of people on it and you haven't marketed to that wait list yet, and you haven't emailed them and it's been a year, you better start doing that. So there's actions that you need to take, right? But in the early days, it's all about that story. And it's all about finding those metrics that enable you to tell that compelling story. Happy to go into much more detail. That's the substance of what I had today. And so I would love to just open it up for conversation. Those of you that want to just pick my brain on fundraising, on the process, on all that stuff. I'm a venture partner with Republic. So if anybody wants an intro to Republic, if you're post-revenue and US-based corporation, I can get you straight into the investment team. I'm also very well connected with the Launch Accelerator and have made a few company recommendations in. They generally are at a little bit later stage. And yeah, to Joe's point, like a lot of this is about your story and conviction. You know, Growth U, my latest company, is not a pure product company. So it's actually harder for us to raise money, even though we've got really strong traction, than it is for a pure product to raise money with less traction. And that's okay. So we've set our fundraising expectations accordingly. We're not trying to raise a $10 million round right now. We don't have an insanely high valuation. We're very realistic because we know that we're doing some stuff manually, and that's okay. We've built businesses like this before, and we've got a product that's being built alongside of all the stuff that we're doing. So you just got to figure out what your message is, where you're going to lean in, what your strengths are, understand where your pitfalls are. A question that we get asked a lot is, well, you tell this future vision of this product, you know, why should we trust that you can build this thing? I'm like, well, I've spent 22 years building stuff. You know, like I started as a software engineer and was a product manager for 15 years. And the number one reason why I've seen startups fail, by the way, is that they overbuild before launching. You tell that to an investor, they're kind of like, okay, I get it. But it takes a conversation for that. And that's part of our narrative and part of our story.